Welcome to the deep dive. Okay, so if you're trying to understand how Warren Buffett, probably the world's most famous value investor, actually picks stocks, well, you hit this weird contradiction pretty fast.
Right.
I mean, Standard Investing 101 tells you obsess over price to earnings, PE, and price to book, PB. But then Buffett himself keeps saying, nope, those aren't really my main focus.
That's exactly the puzzle we're diving into today. Buffett basically says, relying only on PE and PB, it's like trying to figure out what something is just by looking at its shadow.
Just shadows.
Yeah, at best, they're just clues, as he puts it. So our mission today is to give you that shortcut, to really get what he truly values, this kind of elusive idea of intrinsic worth.
Okay, so we're going to follow the journey, right? From simple statistical cheapness all the way to the more complex sort of qualitative judgment he uses now. But we got to start at the beginning.
Absolutely, with his mentor, Benjamin Graham.
The Graham Foundation.
Exactly. And Graham's starting point was famously called the cigar butt approach.
Yeah, the cigar butt. Sounds appealing.
Well, the idea was you look for these, frankly, mediocre businesses, but they're trading at incredibly low prices. Statistically, super cheap.
So the thinking was, buy it so cheap, even if the business is, well, kind of crummy, there's still one last free puff of profit left in it.
Precisely. And critically, you bought it so cheaply that your principal, your initial investment, was protected from, permanent loss.
Okay. And under that Graham system, those two metrics, PE and PB, they were key, weren't they? They stood in for the two big things investors always want.
That's right. Safety and return.
Safety and return.
So the PB ratio, price to book, that was your proxy for safety. If you bought a stock with a PB under 1.5 or even better, under 1.0.
Below 1, wow.
Yeah, it meant you were literally paying less than the value of the net tangible assets sitting on the company's balance sheet. So if worse came to worse, like a liquidation.
Did you get your money back, or most of it?
That low book value gave you that margin of safety. It increased the odds of getting your principal back.
Makes sense. And PE, price to earnings, that was the return part.
Exactly. Proxy for return. A low PE, let's say generally below 15, implied the business was generating a high earnings yield relative to the price you paid.
Like a PE of 5 means what? A 20% earnings yield?
That's the math. Simple as that. High yield on your investment.
Okay, and the classic example of this in action is Buffett's own purchase of Berkshire Hathaway, right? The textile mill back in '65.
Perfect example. The absolute quintessential cigar butt. He got control of this textile mill, paying a price that worked out to a PB ratio of only about 0.76.
0.76. So he was paying less than the net asset.
Way less.
Yeah.
He basically paid nothing for the actual factory, the machinery, because the net working capital cash, receivables minus payables, covered his whole purchase price. And the forward PE ratio looked good too, around 7.0.
Okay, the numbers look great. Statistically cheap, high safety margin on paper. But didn't Buffett later say buying Berkshire was a massive mistake, a monumentally stupid decision?
He did, and that's the crucial turning point, because the numbers, they didn't tell the whole story about the future.
What went wrong?
That textile business, it was what he called a capital sinkhole, a really terrible business in a dying industry. It needed constant, huge injections of cash.
Just to stay afloat.
Just to stay competitive.
Yeah.
He was pouring money into upgrading machinery simply to keep the business running, not to grow it. And that just destroyed the long-term returns. The initial statistical safety meant nothing against the awful economics of the business itself.
Okay, this really highlights something important, doesn't it? You can nail the valuation of one specific company, but you also need to understand the bigger picture. What's the overall market doing? Are we in a bubble, or is everyone panicking? Context matters.
Absolutely critical. Your best analysis can be undone by buying at the peak of a mania.
Right. And actually, for tracking that overall market temperature, sort of keeping that big picture context while we're digging into these company specifics, we really recommend checking out an iOS app called Buffett Indicator.
Oh yeah, that's useful.
You can find it on the Apple App Store. It basically tracks market bubble conditions using Buffett's favorite macro signal and gives you reminders. It's a pretty handy tool, for grounding your individual company valuations in the broader market reality.
Definitely helps avoid getting swept up. So that failure with the textile mill, that directly led to this huge intellectual shift, really pushed by his partner, Charlie Munger. And it's summed up perfectly in that famous Munger quote, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
The quality over cheapness argument.
Exactly. The core lesson became, Time is the friend of a great business, but it's the enemy of a mediocre one. Doesn't matter how cheaply you bought it initially.
Because the mediocre one just keeps sucking up cash.
Right. You need a business that actually generates cash, ideally without needing tons of reinvestment just to tread water.
Okay, so this meant moving beyond Graham's statistical safety net.
Completely. And the landmark case study here is See's Candies, which they bought in 1972. This purchase just flew in the face of the Graham method. They paid $25 million for a company that only had about $8 million in net tangible assets on its books.
Wait, hang on. $25 million for $8 million in assets. That's a price-to-book ratio of, what, around 3.1?
Yep, 3.1.
So if you're ignoring the safety net of the tangible book value, what's the margin of safety based on then? Where does it come from?
It came entirely from the quality of the business, specifically the brand. Munger saw what he called the power of a good brand. Intense customer loyalty. People loved See's.
And that meant?
It meant they had huge pricing power. They could raise the price of a box of chocolates literally every year, and customers would just keep buying. They wouldn't lose volume.
Wow. That's a powerful moat.
Immense, and the results just prove the point, right? See's Candies has generated, get this, over $1.35 billion in pre-tax earnings since they bought it. Billion with a B, and it only needed about $32 million in additional capital investment over all those decades. Just a cash machine. That durable brand, that loyalty, that became the new superior form of safety.
Okay, so this leads us right to Buffett's big critique of the old metrics, doesn't it? In his 2000 shareholder letter, he really laid it out.
He did. He stated very clearly, PE and PB have nothing to do with valuation except to the extent they provide clues to the amount and timing of cash flows.
Clues again. Just clues, not the actual math.
Exactly. And the problem is, especially in the modern economy, those clues can be really, really unreliable.
How so?
Yeah.
Let's break that down. The PE ratio, price to earnings. What's the flaw there?
Well, the big issue is the E, the earnings figure. Specifically, earnings reported under GAAP, generally accepted accounting principles. Buffett argues GAAP can be seriously misleading.
Why? What's misleading about standard accounting?
One major thing he pointed out is that GAAP forces companies to include unrealized gains or losses from their stock portfolios in their reported earnings each quarter.
So if the stock market tanks, a company's reported earnings can plummet, even if its actual operating business selling widgets or whatever is doing just fine.
Precisely. It creates these wild and capricious swings, as he put it, in reported profits that have nothing to do with the underlying economic health of the actual business operations. It's just noise.
Okay, that makes the E unreliable. What about PB, price to book? You said that's even more outdated.
Oh, absolutely. Buffett calls book value an anachronism. Think about it. Book value was designed for the industrial age. It's good at counting things like factories, inventory, machinery, tangible stuff.
Right, physical assets.
But today, what are the most valuable assets for many companies?
Brands, software code, customer relationships, intellectual property.
Exactly, intangibles. And those incredibly valuable assets, they're often barely reflected or completely absent from the traditional balance sheet. So book value misses most of what makes a modern business valuable.
So ironically, a low PB ratio today might not mean a bargain.
Buffett actually said, it often suggests you're looking at a poor business, not a cheap one. A business reliant on old economy assets that maybe aren't earning great returns.
Okay, so if TE and PB are just unreliable clues, what is the destination? What's the North Star? Let's define intrinsic value.
Right. Intrinsic value is the concept he aims for. Simply put, it's the discounted value of all the cash that can be taken out of a business during its remaining lifetime.
Okay, the cash you can pull out. But that number isn't printed anywhere, is it?
No, you have to estimate it. And to do that estimate well, Buffett realized he needed a better measure of true profitability than GAAP earnings. That's what led him to develop the concept of owner earnings back in 1986.
Owner earnings. Okay, now we're getting past the shadows to the substance. How do you calculate this? What is owner earnings?
The formula is designed to cut through that accounting noise we talked about. You start with the reported net income, the GAAP number.
Okay.
Then you add back non-cash charges, things like depreciation and amortization, because those aren't actual cash going out the door.
Right. Standard cash flow adjustment.
But then comes the crucial step. You subtract an estimate of maintenance capital expenditures.
Maintenance capital expenditures. Okay, that sounds important. What's the difference between that and just regular capital expenditures?
This is the key distinction. Think about it like owning, say, a fleet of delivery trucks.
Okay.
Maintenance CapEx is the money you absolutely have to spend each year just to keep the current fleet running. Replacing worn-out tires, engine repairs, oil changes, stuff needed to maintain the existing level of business, keep things safe and competitive.
Got it. Keeping the current trucks on the road.
Exactly. Growth CapEx, on the other hand, is the money you spend to expand the business, buying 3 brand new trucks to serve a new city, for instance.
So owner earnings subtracts only the cost of maintaining the current operation, not the cost of growing it.
Precisely. It represents the cash flow that the actual owner could theoretically pocket each year without damaging the company's long-term competitive position or its earning power. It's the true sustainable cash generation.
And calculating that requires more than just looking at a financial statement, right? You actually have to understand the business well enough to estimate what that maintenance number is.
That's the critical part. It forces you to make a judgment, a qualitative assessment of the business and its needs. It's not just plugging numbers into a formula like a PE ratio.
Okay, so this whole shift, driven by Munger, focusing on quality and owner earnings, we should see this reflected in Buffett's big investments after the See's Candies era, right? Even if they looked expensive on old metrics like PB.
Absolutely. Look at Coca-Cola. When he bought heavily in 1988, the PB ratio was high, around 5.1x.
I times book. Gray would have choked.
Probably. But the reasoning wasn't about the assets on the balance sheet. It was purely qualitative. The incredible durability of that global brand, a massive economic moat. The pricing power, the certainty or near certainty of future cash flows as the world drank more Coke. The balance sheet just didn't capture that immense value.
And fast forward to the modern era, Apple in 2016.
Same logic, different industry. He started buying Apple when its PB ratio was roughly 8x.
8 times book for a tech company.
See, that's the key. He argued he wasn't looking at it as a typical high-risk tech company with rapidly changing products. He saw it as a consumer products company.
Like See's Candies or Coke.
Exactly. With an incredibly powerful ecosystem mode. The iPhone, the App Store, the services all working together, creating immense customer loyalty. People were locked in and happy. It was the See's Candies logic, identifying that intangible competitive advantage applied to the digital age. The high PB was irrelevant compared to the future owner earnings potential.
We should probably also mention that American Express story, the salad oil scandal back in '64.
Yeah.
It really shows this qualitative focus under fire, doesn't it?
Oh, absolutely. Classic case. A massive fraud involving non-existent soybean oil caused Amex's stock to completely crater. The financials were a mess, total panic in the market.
What did Buffett do? Did he try to sort out the numbers?
No, he didn't wait for clean financials. He did what he called scuttlebutt research. Basically, hitting the pavement, doing on-the-ground checks.
Like what?
He went around his hometown, Omaha, talked to restaurants, hotels, looked at whether ordinary people were still using American Express travelers' checks and cards.
And were they?
They were. He found that the customers, the end users, were basically unfazed by the Wall Street scandal. The brand loyalty, that deep-seated trust in the Amex name, the moat, was still intact.
So he ignored the panic and the messy financials.
Totally focused on that qualitative strength. He famously invested about 40% of his entire partnership's capital into Amex during the crisis. He reasoned that if the core business quality, the brand's power with customers, survived the scandal, the underlying economic strength was still there, regardless of the temporary accounting chaos.
Incredible conviction based on qualitative insight.
So, if we try to tie this all together, unify the framework for you listening. The real foundation of Buffett's success, especially post-Munger, is clear. You have to change your mindset. Think like a long-term business owner, not just a stock picker.
Understand the business deeply.
Right. Understand its competitive advantage, its moat. Then estimate its true cash-generating power using that concept of owner earnings. And then apply a conservative margin of safety to your estimate of intrinsic value.
And that brings us to our final, maybe provocative thought for you to consider. That calculation of owner earnings. It's really where investing becomes more of an art than a science, isn't it?
I think so.
Because it forces you, the investor, to step away from just mechanically plugging numbers from a report. You have to make this crucial, often difficult guess about the future, specifically, about future maintenance capital needs.
A guess that isn't written down anywhere.
Exactly. It's not on any financial statement. And making that essential guess requires that deep, qualitative business understanding we've been talking about. That's arguably what separates a truly great investor from, say, just a competent accountant following the rules.
Well said, it's about judgment.
If you found these insights valuable and you want to go even deeper on topics like this, definitely remember to subscribe to our full deep dive channel. It's called Deep Value Investing, available on Apple Podcasts and Spotify.
And just a reminder, disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Always conduct your own due diligence before making any investment decisions. And yes, if you want to hear more full deep dives, please subscribe to us on Apple or Spotify Podcasts channel, Deep Value Investing.